Monday, April 21st, 2025. I hope you had a good weekend. Before we dive on in, do me a favor and hit the like button, subscribe to the channel, but let's go ahead without further ado. First, we have from Tech Dev. I don't know if many of you remember Tech Dev from 2021. It seemed like every other tweet of his in 2021 I saw on my timeline. But anyway, altcoins don't run until liquidity breaks out. It is time. And so you can see a chart here with global liquidity, and you can see it's pretty simple, right? Red and blue. On the bottom, we have negative liquidity times, and on the top we have blue liquidity when liquidity is high. And so what's the point with this? This chart dates back to 2013. As soon as we start seeing an uptick in global liquidity, then it's time to buy altcoins. I would argue that we're not quite there yet if we're going to go according to this chart. But, as always, it's something to monitor. When we see some kind of reversal in global liquidity, according to this, then we should be ready to move higher. So just FYI for this video, I have a few bits of hopium, and then one thing in regards to liquidity, at least, that I'm not too excited about to share with you. So buckle up. But anyway, Thomas Ferrer, BlackRock buys 955 Bitcoin. Flows are coming back. It's nice to see that BlackRock is buying Bitcoin, or at least they did on a specific day. What I really am intrigued about with this chart is just you can see their buys, how much it's correlated with Bitcoin's price going up. And then when it was flat, Bitcoin's price being kind of flat. And so the early days of buying from BlackRock, we saw Bitcoin hit a new all-time high before the halving, and then we chopped for 6 months. And then around the time of the election, lots of buying of Bitcoin from the IBIT ETF. And as of right now, they have about 578,000. It's pretty crazy, about 578,000 Bitcoin in their holdings. So on a given day, April 17th, they bought 955. I monitor this every day. It's just pretty flat right now, which you can see with the IBIT chart here, but it's something that I'm very much wanting to monitor because there was a time early this year when IBIT was hemorrhaging and all the spot Bitcoin ETFs were hemorrhaging, but they've been pretty flat recently. So hopefully, there's a sign of a reversal there, and we'll see heavy buying of Bitcoin, especially, it would be great as if that happened with global fears increasing, that people would see Bitcoin as a safe haven along with gold. But we're just going to have to see what the market gives us. Something else, Mr. Crypto, again, I talked about him in yesterday's video. He is the most bullish person I have seen on X. And so here's what he says: the Bitcoin bottom is in. Doesn't get more obvious than this. We're about to create generational wealth. This is the one who I said, according to his chart in yesterday's video at least, that there was a upside potential of 550% in Bitcoin, which would put it where, like $600,000. And so we'll see. That would be really nice. I wouldn't complain about that. I'm a little skeptical, but anyway, this is a compelling chart. I want to be clear about that. This is pretty compelling here. You look at realized cap net position change. And so April of 2024, we saw the realized market cap spike up big time. And then, it was a decent amount of profit taking as we consolidated. I wouldn't call that distribution. I guess you would call that reaccumulation. And then again, a big spike up in realized cap. But then the net position change, it's gone down below this line here, which typically, at least in a bull market, would mark a bottom. But the question that I would want to ask is, are we in a bull market? I tried looking for this chart in late 2021, early 2022. I couldn't find it. I couldn't even find it. A lot of Glassnode charts are behind a paywall on their website. I couldn't even find this chart on their website. I'm not arguing that this is not on Glassnode. It was just difficult for me to find. But I do wonder what it would look like from November of 2022. Regardless, if you're of the mindset that Bitcoin does have another run to go higher, which I am open to that, then this is a very compelling argument to buy Bitcoin right now and to just hold on for hopefully another significant move higher. We'll see. Just like I said, intriguing chart. So now, actually, this is not the chart that I was expecting. Let me get to the chart that I was expecting to share here. This is it. Let me move this tab over. So I don't want to throw rain on anyone's parade. I just want to think as level-headedly as possible, if level-headedly is a word. Okay, so from Rick Untz here, chrono_chartists, you see lots of M2 charts going around, right? Have they told you that there is something like productive credit or deficit financing? This chart means the new liquidity is being used to service debt, not for growth. Liquidity right now being used to service debt, not for growth, meaning it all gets absorbed at the moment and not in the markets. I think that's ATM at the moment, whatever, I don't know, but they don't tell you because they parrot what they see and do not really know. And this was a compelling argument with the whole liquidity mindset that, we're seeing M2 rise around the world and Bitcoin is 108 days or something behind liquidity's rise. And if that were the case, if we're going to follow global M2, what we would see is something like a $140,000 Bitcoin in June. Well, here's a counter argument to that. You can see at certain times, in particular recessionary-like times, there are times when liquidity rises, and that's used to just service debt. And you can see what's happened during these times when that's been the case. And it's always accompanied some kind of a drawdown in the stock market. And so are we in a similar position right now where we're just servicing debt? That's the rise of M2. Now, the most recent one before this time now was the COVID crash. And so, all right, COVID crash, we serviced the debt, and then M2 skyrocketed around the world. And that certainly saw a significant advance in the SPY and the Dow Jones, and of course in Bitcoin and in altcoins. So maybe after a season of pain comes a great deal of relief, but we're just gonna have to wait and see on that. Just another thing to put in your tool belt if you're hearing people talk about M2. For me, M2 is more of a wait and see kind of thing. I'm hopeful, but I'm not putting all my eggs in that basket. All right, moving on to the chart that I did click on here. Gold ETF call volume, you can see this dates back to 2008. The GLD ETF is at an all-time high for call volume. What is a call volume? That's betting. That's greed. That's a sign of greed in the market for gold. Okay, so that's betting that gold is going to go much higher right now. So is that a sign of peak fear? Or is it a sign of extreme greed with gold? Whatever the case, I would think that gold is going to cool off for a bit. And, I've shown several charts in my videos talking about when gold cools off, can we expect Bitcoin to climb? There's some people who argue that it's going to take another 6 months before we see any kind of significant advancement in Bitcoin. Other people who say it's imminent. Whatever the case, this, you could call it peak fear with the stock market, or you could call it peak greed with gold. That seems to me like, I sold a lot of my gold, not all of it, but some of it, about 10 days ago. And I don't think I'm going to end up regretting that. Some people are definitely challenging me on that, but it is what it is. I'm not going to be too worried. Profits are profits. So peak fear, stocks have struggled while gold soared on safe haven demand. GLD gold ETF call volume hit an all-time high. Is it time for stocks to rally as gold cools off? ? Compelling reason in this chart to think maybe that's the case. Moving on, the Magnificent Seven. Speaking of stocks rolling while gold cools off, I'm just not a fan of the Magnificent Seven. I've shared, right now at least, I've shared this perspective in several different videos, including my video yesterday where I showed the gap between the top 7 stocks and how much buying of the top 10 stocks. So how much buying of the top 10 stocks there has been over the last couple of years in comparison to stocks 11 through 50 in terms of market cap. Several of the Magnificent Seven stocks are within the top 10. And I think it's been a little bit too much, a little bit too heavy buying, and we're in the middle of a long overdue correction in the Magnificent Seven. Now, that doesn't mean that we're in the middle of a long overdue correction with the rest of the stock market. It seems likely to me that there's going to be some sign of breadth, that if we saw the rest of the stock market go up, the S&P 500 increase over the remainder of the year, or whatever that would look like, that it would involve an outperformance of the stocks with market cap 11 through 50 over the Magnificent Seven or the top 10 stocks in the world in terms of market cap. Just something to keep your eyes on. Magnificent Seven has lost 4.4 trillion in market value since its December peak. This is nearly twice the value of the German stock market. These stocks reflect circa 29% of the S&P 500 market cap, down from a record 34%. Is more downside ahead. So wow, I didn't even notice that the Magnificent Seven at one point was 34% of the S&P 500. So this is not a bet that I am willing to make right now. I think if you bought into any of these, you had a great run. There's certain ones like Nvidia and Meta in particular that I think have a decent amount lower to go still. And a chart here that's a comparison. I can't click on it and make it larger, but this is comparing Nvidia to Cisco's chart during the dot-com bubble. And I do wonder, I have a lot of hope for NVIDIA because of the AI components, but I do wonder if short term, at least, we're going to see NVIDIA continue to follow what we saw with Cisco in the late 90s. If you looked at Cisco's stock at any point throughout the aughts, what you would have seen was a pretty flat stock. Now, I don't expect NVIDIA to do that. I think we're very early with AI, but for now, I wouldn't be surprised if NVIDIA continued to follow this fractal. And so that's one of the Magnificent Seven. That's not all of them. That's one that I am in particular not too excited about right now. And I'll even be honest with you, I have an inverse NVIDIA stock in my portfolio, and it's done pretty well lately. So that's the ticker NVDD. That's how much I don't believe in NVIDIA short term. Now, at some point, I'm going to sell that and sell it aggressively and then never look back. But now I'm just going to hold on for the time being. Moving on, Julian Battelle. Totally agree with Dan on this. Now, this is another post that has some reason for hope. Here's a snippet from our latest MIT report, which dropped yesterday on Real Vision. Tech stocks were recently the most oversold we've seen since COVID. And get this, only 7 other times since 1988 have more than 55% of NASDAQ 100 stocks traded with a 14-day RSI below 30. The company it's keeping, this is the part that I really wanted to highlight here. 1980, we saw the Iraq War / oil spike. 1998, Russian default, LTCM. If you guys remember, the Roaring 90s is kind of like an up-only period. And yet there was this period in 1998 where there was a great deal of fear in the market. That's what that was. And I remember gas prices being very cheap at that time. Those were the days. September 2001, obviously 9/11. October 2008, the Lehman Brothers collapse. August 2011, the U.S. debt downgrade, Eurozone debt crisis. I remember that. I remember that day in particular where United States, I forget who it was. It might have been Standard & Poor's. They downgraded our credit rating from AAA to AA or something like that. So that was a really scary moment. And then we recovered really fast. And then August 2015, RMB devaluation. And then, of course, March 2020, COVID. So you're telling me equities are as oversold now as they were during COVID when the entire global economy basically shut down. His point in this is that this is wildly overblown. If you want to look at this tweet, just look up Julian Battelle, username Battelle Julian, and look at these charts here. There's a lot more information that shows consumer confidence and American Association of Individual Investors survey. I have talked about that. There's a great deal of bearishness right now that would at least support the argument for some kind of a relief rally. I would tend to say, let's think through the worst case scenario when it comes to what right now gives us. There is a worst case scenario in my head, at least, that's pretty dark. Now, again, relief rally, right? But there's a scenario in my head that's really dark, that we are at the end of a 40-year or even 100-year experiment gone wrong, and we're going to be on the receiving end of a lot of pain. So again, worst case scenario. I'm not saying that this is absolutely going to happen, but there's some things that I would say, especially looking, the 40-year scenario is just looking at rates, at interest rates over the last 40 years and how they've continued to come down and down and down with slight raises. And then we went down to zero. And now I wonder if there is a shift in the thinking of powers around the world when it comes to seeing the US dollar as a safe haven asset. And you can see that in the 10-year yield. It's not just the fact that Japan happens to be selling their treasuries right now and China happens to be selling their treasuries. There may be a broader fear in the market that the US dollar is not as safe of a safe haven as it once was. And COVID certainly exacerbated that as we saw money printing out the wazoo. And what happens in response to loss of confidence around the world is the Federal Reserve decide to print a lot of money and to buy trillions upon trillions of dollars worth of treasuries. Could it be that they end up buying $10,000 worth of treasuries to kick this can down the road and to instill even less confidence in the US dollar? Like, anything's on the table. I mean, maybe I don't know what comes next. I think we only have one more bullet left in the chamber when it comes to this quantitative easing and funny money clown world experiment. And I kind of hope I kind of hope that's the case, even though it's going to make things worse, because I just want to be like a squirrel gathering my nuts in the winter. But anyway, moving on. After saying all that, this chart should be pretty hopeful. Here's historical performances of the S&P 500 index during the U.S. bull and bear markets. And you can see significant moves up and very minimal drawdowns. And so, is this what the future holds for us? Now, this is between 1956 and 2017. We don't have the COVID crash. We don't have anything recent, but we do have the great financial crisis. And looking at this chart, the drawdown, we are talking about a 51% drawdown, but the drawdown in comparison to the markup is quite significant. So there is on my end some buying, some DCAing going on with certain assets, with some stocks in particular, some dividend yielding stocks, because of this mindset. Okay, we're in a drawdown. Well, here's what historically it looks like, and let's just try to navigate through this. That worst case scenario that I presented, it's just a scenario. Here's another scenario. This is a fantastic time to buy. So I want to operate with this mindset for sure, that it may not end up being the end of the world when it comes to at least the S&P 500. And last but not least, all right, here's why I have a hard time believing anything that comes out of the mouth of Jerome Powell. This was really fascinating to look at. So, United States annual inflation rate paired with statements by the Federal Reserve. So we have January of 2020, 2%, and then dumped down really hard after the COVID crash. So we must combat deflation risk in early 2020. Interesting. So we got to print. And then May of 2020, no risk of inflation. Let's print. And then we're rising a little bit. Just the base effect, print. Will revert in second half of 2021. We're going to revert in the second half of 2021. And inflation's getting up to 4% and 5%. Temporary factors. Let's print. Transitory inflation. How about we print? It's largely transitory. It's transitory but persistent. And then finally in December 2021, think November 2021, November 10th of 2021, the CPI report came out. It was at 6.9, unexpectedly high. And some people, I would even say myself included, wrongly reacted to that, like, oh my goodness, Bitcoin's going to go crazy. But then other people thought about the effects of 6.9% inflation, and they rightly assessed that, oh my goodness, the Federal Reserve is going to have to do something really soon to combat this. And then, as soon as 2022 came around, they started raising rates very aggressively. But that's another story for another time. Here's the deal. These are all lies. These are all lies until they can't lie anymore. And so that's why whenever Jerome Powell speaks, I put on my thinking cap and I try to discern everything that he says. And if ever you read a statement from Jerome Powell or you hear him speak, you have to have that in mind. Okay, so the messaging recently is that they're pretty comfortable sitting on their hands and letting this thing with the tariffs play itself out. And at some point, they're going to be very uncomfortable, I think. And then it's going to be very interesting to see how they respond to that. So anyway, that is it for today. Best of X. I hope you enjoyed. I hope you have a great start to your week. And yeah, have a good one. I'll see you next time. See you tomorrow in another video. But anyway, that's it. Have a good one. Peace.